Did U.S. Treasuries cause the collapse of Silicon Valley Bank? That's what I'm thinking about. As I'm recording this, there's a lot of talk in the markets about the collapse of Silicon Valley Bank, one of the largest bank failures in American history. There's a lot to be concerned about with that, but I wanted to dig into one thing. I was talking with a friend of mine who had read an article about the collapse, and one of his comments was, the bank bought 10-year treasuries, and those things, and treasury bills collapsed, and that was really the cause of all the problems. And that's factually true in some cases, but it really requires some context. I wanted to share some of that. At some of the statistics and some of the data, what I did is I looked up values for Vanguard index funds that invest in treasury bills. We'll pull up the graphic here. You can see on the top we've got the ultra short treasury index, and then the short treasury index, and then intermediate and long. And in the middle column here, what does that exactly mean? One of the ways to measure it is with average duration, meaning how long is that bond that they own inside those mutual funds, or the typical bond. Ultra short year, right about one year in the ultra short, about 2 years in the short, and you can see 5 and 16 years in the medium and long-term bond funds. And one of the things about how bonds work is the longer you buy into a bond. Think about it. If you buy a 5-year CD, you expect to get a higher return than if you buy a 6-month CD, right? Similar thought process. Longer-term bonds typically get higher returns, but when interest rates spike up, they go down. And so there's some risk that goes into that if you ever have to sell the bond. If you keep the bond for 16 years, a long-term bond, you're going to get exactly what you put into it. But if you have to sell it in the meantime, you might take a little bit of a loss. That's what happened with Silicon Valley Bank. They had to sell some bonds to make some redemptions, and they had to sell them before maturity. And what it sounds like is that they invested in some of these longer-term bonds on the bottom of this scale here. And what happens, why did they do that? Because they thought they were going to get better returns over time. But when you had to sell into that thing, look at those returns on the far right-hand side. The longer the duration of your bond, as interest rates go up, look at those, double-digit, numbers as far as a decline. So was it treasuries that caused this? Well, sort of, the investment in the treasuries, but it was the investment and the length of the treasuries, right? The bank could have chosen to get lower returns on average and use some short or ultra short bonds, and then they might have seen some of the losses, like those tiny losses, maybe less than 1%, right? Maybe a few percent, a lot different than 20 or 30%, right? And so were treasuries the cause? Yeah, kind of. At the same time, it was probably more decision-making on, I'm going to try to get returns as opposed to being safe. And as viewers know, we believe that the bond side of our portfolios should be about safety. The stock side should be about getting returns and balancing risk and return with that. I think it was Warren Buffett once said that more money has been lost striving to get yield in bonds than at the point of a gun. And I think that's maybe what we saw here last year with those things. So I thought some frame of reference as you think about, oh boy, are treasuries scary? It depends, and being smart and intentional about your investing and managing that risk is really important. So that's what I'm thinking about today. As always, interested in knowing what you're thinking about, especially if you disagree. Shoot me a comment in the box below, and love to have a conversation about that, or drop me an email directly. And as always, thanks for watching.